Hello, thank you for joining me, Fiona Cincotta, here at StoneX. And today I have the pleasure of talking with Rhona, who is Head of Market Analysis, EMEA and Asia. Thank you for joining us today.
Great pleasure. Thank you for having me.
And a great time to be talking about gold as well. I mean, it's very much been in the headlines. We've seen record highs coming. What do you see as the key drivers here and the $1 million question, or should I say $3,500 question? Do you see it continuing?
If you're JP Morgan, you'd be saying $4,500 question. It's the U word, uncertainty, which is probably the most used word in the market analyst vocabulary for the past 3 months or so. We're all using it. It's going onto my bingo card of words that I won't use, like hawk, dove and pivot. Uncertainty is right up there with those three. Obviously, that's a flippant way of looking at it, but predominantly it's driven by uncertainty surrounding geopolitics, which is not just international armed tension, it's trade wars, polarization in different countries in terms of political parties because of not quite austerity but fear thereof, all those different elements coming together. And people will also cite the central banks. Now that is important in the sense that the official sector is a large buyer, has been for the last 3 years. It's not so much the tonnage, which, to put into context, last year they did a net just over 1,000 tonnes, and global mine production in any one year is about 3,600. So they're taking a lot of metal off the market. But it's much more important in terms of the message that they're sending to the rest of the world, because they are hedging against not just, quote, dollar weaponization, close quote, but against any kind of fiscal risk. Right. So if that were to stop, then obviously the tonnage would make a little bit of a difference. It's a very good support element, but it's much more a question of sentiment and messages.
Yes, completely. And I mean, do you then see central banks then continuing with this buying? That's what we're sort of looking at here.
Yes, absolutely. Particularly as it's looking at the moment, very early days, as if the policies that are coming out of the White House will serve to weaken the dollar, if only because, again, of a lack of decreasing confidence, should we say. Now, whether that's going to be one quantum change or whether it's going to carry on like that is hard to tell. I suspect there'll be a tail risk. We're in the eye of the storm at the moment, I would say, particularly with the Liberation Day that's coming tomorrow. Definitely. With the tariffs.
Completely. And I guess the other thing to be working here is, or talking about here, is inflation. I mean, there is this sort of sense that the tariff policies could be inflationary for the US potentially, but then obviously if we see it having sort of a negative impact on growth, that might offset the inflation. Uncertainty is overshadowing inflation right now, would you say, as far as gold is concerned?
Running a close second, I would say, because again, they're intertwined. Everything in this market talks to every other bit, really. Inflation, there are so many arguments out there. I don't know which is the right one as to whether the imposition of tariffs is going to be inflationary full stop, or whether it's going to be one quantum leap and then again things tail off. With the unravelling of the USMCA, the United States, Mexico and Canada Act, there are, I didn't count them one by one, but in terms of the number of sheets in the annex, there's something like 13,000 individual products that are covered by USMCA. Now, if they all come off, it's going to take ages for everything to work its way through. So the concept of a one-off hit sounds attractive, but it's going to take a long time to implement. And there are two senior aides to the president who are talking about the way that this should be done. One of them is talking very much on a combative basis, take a negotiating position, then, quote, do a deal. The other one wants it more entrenched in a legal basis. I haven't phrased that very well, but he wants more of a legal structure around it, which would be the more viable way of doing it. But that gives you an additional lead time of about 6 months, as if we didn't have months to wait for everything to work its way through anyway. So it's going to take a long time. And that, of course, leads to stagflation, which I think is probably the key word that we should be talking about now.
Yes, completely. I mean, that is being mentioned a lot now as well, isn't it, with the prospect of that slowing growth and rising inflation, or sticky inflation at least. And I mean, tariffs on gold, we're not looking there, are we?
I don't think so. It's a reserve asset. How can they, she says. We'll probably find 0900 hour EST tomorrow morning, bang. It's very unlikely. It doesn't make any financial or political sense at all. But that leads neatly into the dislocation argument that we've been going through for the last 3-4 months or so, which I'd just like to touch on a little bit.
Yep.
The rules under the Chicago Mercantile Exchange regulations are that it doesn't apply to all metals, but certainly applies to gold. Anything that is registered as good delivery for COMEX and is involved in a contract, an active contract, can only be vaulted within 150 miles of New York City. So, early December, markets start thinking about tariffs, and risk managers start thinking, not just in gold or in financial sector, but everywhere, start thinking about fast-tracking materials into the United States. The auto sector is a very good case in point. What is visible is the daily announcement from the CME of their level of inventories. Now, there's two background elements here. One is that historically, whenever I've looked at these numbers, roughly 40% of total aggregate open interest in gold contracts has been covered by metal in warehouse. Again, point number two, it's very rare for more than 5% or even as much as 5% of short positions being settled physically. It's almost always closed out. So you've got say a 5% benchmark, 40% normal cover just to be on the safe side. We are now up to 83% cover. Something like 650 odd tons have gone into New York. A lot of that has come out of the Bank of England vaults. But London good delivery bars are 400 ounces, which is 12.5 kilos, with a percentage tolerance on either side. They don't have to be bang on. COMEX good delivery are either 100 ounce or a kilo. So London is not good delivery. Now, during COVID, when we had these problems again because people wanted to get the metal where it needed to be and they wanted to do it in a hurry, there was a period of time where the COMEX regulations were eased so that tranches of 400 ounce bars could be used against COMEX good delivery. Now, that hasn't persisted. And I know that Ruth Crowell, who's the chief executive of the London Bullion Market Association, has been saying that we should be talking about this. And frankly, I really do think we should.
Yes.
It doesn't make sense for London and COMEX not to be fungible. It really doesn't.
Yeah.
So basically what we've got now, as I say, is something of the order of 650 tonnes have gone in for a total of, I think it's about 1,300 tonnes now in COMEX vaults. And my point about coming out of the Bank of England, because they're not fungible, the metal is going into Switzerland, being refined by the Swiss refiners into 100 ounce bars, then making their way across to New York. It's also coming out of Australia, it's coming out of Asia. The Australian and the Asian material wouldn't have to go through Switzerland, generally speaking, because they do 100 ounces anyway, or they certainly do kilo bars. So whereas ordinarily it would only take 8 days for metal to come out of the Bank of England and get across to New York, now it's taking up to 6 weeks. The Swiss refiners are working 24 hours a day, 7 days a week, which is nice business. But because leasing rates are high because of the dislocation, that's costing them. Right. So nobody's really winning at the moment.
Yeah, completely. No, that sounds extremely interesting, actually, that dislocation. And do you envisage a change then coming potentially?
It would be nice to think of it. I don't know. It would take a lot of negotiation. During COVID, I did actually ask someone from the CME why they don't have vaults in, let's say, Hong Kong.
Right.
And the answer, I'm not sure whether it was off the record or not, but I'm not going to say who it was. The answer was too close to China.
Okay.
Political risk, I guess.
Yeah, completely. And then what do you see as a risk to the upside in gold that we've seen in the prices? What would be the risk there? What would we need to see or change in order for the price to come back down again?
The risk to the gold price would be a massive reduction of risk for the rest of us.
Yeah.
I said to someone recently, on humanitarian grounds, I would like to see the gold price peak this year, because that implies that geopolitical risk is subsiding and hopefully armed tension might start to dissipate. Who can tell?
Yeah.
But that would be the key.
Yeah. Excellent. Well, thank you so much for sharing your insights with us, Rhona.
Great pleasure.
It's been an absolute pleasure to have you once again.
Likewise.
For more videos like this, please do like or subscribe.